Good morning, it's Wednesday, July the 1st. We're into the second half of 2026, and here's what's on today's agenda. Kevin Warsh gets ready to make his international debut as Fed chair at Sintra. Japanese business sentiment is booming, and the US lifts export restrictions on Anthropic's Fable 5 model.
Well, it is those comments from Warsh that we expect at 2 p.m. UK time to be a central factor and a central feature for these markets. European futures currently flat, maybe waiting for that. Maybe that's the catalyst. Maybe it's the non-farm payrolls. Maybe that's more important in terms of the jobs market. That data coming through, of course, on Thursday. A decent session yesterday for European stocks, up 0.8% by the end of the close today. Futures currently flat. The Japanese currency remained in focus for us. We've been hearing from Japanese officials speaking to Bloomberg, saying that previous attempts at intervening were successful. Currently 162, close to 163, with further weakness for the Japanese currency. Gold set for its worst quarter in about a decade, down about 14% or so, currently down 0.8% below 4,000. And dollar strength is part of that story as well. The yellow metal, again, facing weakness in the session. The countdown to the opening trade starts right now.
Welcome to the opening trade, everybody. 1 minute past 7 here in London. So, and just under an hour to go until the start of cash equity trading. What will be the big event of the day ahead? Well, it probably will be, as you were saying, Tom, Kevin Warsh speaking at Sintra. Of course, there'll be other central bankers with him, not least Christine Lagarde and Andrew Bailey, and we'll also have the Bank of Canada governor as well. But what's the context to this? And the context to this is that Jerome Powell was very popular in this room, in this club. Talking about central bank independence is very popular in this room and in this club. And so it will be interesting to see how that wider conversation goes down, what kind of figure he cuts and what kind of mood he tries to create. Recent hawkishness is also the context in which we see these central bankers gather over at Sintra. Because, yes, we were anticipating something hawkish, perhaps, because of the higher oil price when we heard at the first Fed meeting from Governor Warsh. But were we expecting it to be quite so hawkish? And are markets still adjusting to some of that hawkishness? We've certainly got the dollar continuing to strengthen. The AI story continues to boom. And all of that puts the focus very much on the strength in the US economy. So that's the sort of backstory as we go into this important moment for Kevin Warsh.
Does that hawkishness get reinforced by whatever he has to say? Because the markets are still ultimately waiting to see which Kevin turns up. We saw the hawkish side of him, of course, at his first Fed meeting, where he emphasised the focus on inflation over the jobs part of the mandate. Bloomberg Economics, I thought, really interesting with their analysis. We see Warsh, above all, as a politician whose rhetoric at the June FOMC meeting played to both sides. They think, our team at Bloomberg Economics think, he's going to stress price stability, and he's going to talk about what happens in terms of the task force. So he may not be tempted to make comments, of course, in the direction of rates. He's made the point that they want to be data dependent, but he may use these 5 task force that he's rolled out for the Fed as a reason to emphasise possibly that the focus should be there rather than hiking rates immediately. That is the take, at least from Bloomberg Economics, ahead of this
Well, if you don't want
speech.
to do any forward guidance and you don't really want to set yourself up, pre-commit yourself to anything, then maybe talking about all these task forces is your safe, it's your safe territory, your safe ground. So maybe we do see him talk more about that. Thinking about forward guidance, we're not getting a huge amount of guidance, obviously, from the ECB. They like to talk about data dependence, about taking it meeting by meeting. We continue to hear that kind of messaging. Yesterday, that was the clear message, wasn't it? We're taking one meeting at a time, but they are, it seems, staying alert to the pricing in the pipeline. So yes, oil prices are considerably weaker than they were, but what kind of price hikes are already in the pipeline because of the volatility, the big spike upwards we saw in the immediate aftermath of the attacks on Iran. So we'll certainly be watching that as we see these central bankers continue their conversations.
And certainly the energy story is part of the focus when we think about Japan. And the currency, clearly, further weakness there for the Japanese currency. Mark Cranfield from my MLIV team saying maybe we need to start thinking the unthinkable when it comes to this Japanese currency. 164, 165. Those are the new levels. As for the moment, at least, Japanese officials stay on the sidelines. Really interesting, though, the comments from a senior, the lead minister when it comes to the FX story in Japan, telling Bloomberg, I thought really interestingly, that when they intervened in April, that was successful. He characterised that as successful. But also this line as well. I'm in touch with my counterpart in the US. He's talking about far more frequently than most people imagine. I think that's really interesting as well, just emphasising that they are coordinating at least unofficially, with the US side on this question of whether or not to intervene and how to manage that currency.
It was also interesting that somebody in his role didn't take the opportunity to really give any further signals that more intervention is coming. So, yes, talking about the successes of the past might be seen in that context, but there wasn't in here any deep messaging, according to our team in Japan, about, stand by, get ready, it's coming on Friday. Of course, we're alert to that because it is a US holiday. I thought in the Japanese context, the other thing that was really interesting and maybe helps us pivot a little bit to thinking more about the BOJ and what it can do about the weakness in the yen rather than what the Ministry of Finance can do. And that's the Tankan survey. So this survey of large businesses in Japan. AI is lifting the manufacturers' mood, it seems. Maybe the weak yen is also lifting the manufacturers' mood. But it's not just in manufacturing, in non-manufacturing as well. We're actually at the highest readings for the Tankan in non-manufacturers since 1991. So something is getting people very optimistic in Japan. The strength of the weakness in the currency and the strength of the equity market, possibly part of that conversation. But you wonder what that means in that BOJ context. Does it give more confidence that they are able to hike rates in Japan?
And as we think about the AI component there and the uplift that is having across Japan, at least in part as a result of that survey or indicated in that survey, we think about the news, which is significant, particularly when we think about the IPO story, but also around the adoption story and sovereignty, which is that the US government, the Trump administration, has now removed these curbs on Anthropic's most cutting-edge models. So Fable 5, along with Mythos 5, they will now from today, be able to be accessed beyond US shores. So what that means, again, in terms of how a Trump administration that's gone from being very laissez-faire in terms of how they control these models to, hang on a second, this is potentially dangerous, the potential for these models to escape their guardrails. They appear to now have, the Commerce Department in the US, some assurances from Anthropic to the point where they can remove these export controls that came as such a shock when they came into force in June.
Yes, and as we go into the second half of the year, interesting to think about where the AI story has come through the first half of the year, Tom. And the rollout of new AI models obviously has been at the frontier very important to that story. But CapEx and who gets the profits from all that CapEx has certainly been part of it as well. We came into the year thinking a lot about how hyperscalers were going to spend a lot of money. We're still thinking about that. But it's not the hyperscalers that are seen as the big beneficiaries necessarily here. They're doing a lot of spending. Where does that money end up? It ends up with the chip manufacturers. It ends up with the memory manufacturers. And so as a result, we've seen such incredible outperformance for some of those semi-companies, but not for hyperscalers and not for software. So in terms of unpacking where the tech story has been over the first half of the year, I think that's important to reflect on.
Also worth reflecting on, at least today, Michael Burry's short position, taking a short position on the SOX. Of course, the semiconductor index, that quote from him saying the semiconductor index, or the SOX, is itself is a pure form of overvaluation in an index, a form that is rarely seen and never so easily recognised. A couple of additional names that he's adding in terms of his shorts with Tesla and the semis index, as well as Caterpillar.
Yes, somebody whose name writes stories ever since 2008. Let us tell you what is coming up on the show today, then. We will be speaking to Julian Lafargue, the Barclays Private Bank Chief Market Strategist. He's talking about power struggles in various parts of the market. We'll also talk to Peter Oppenheimer. We will talk to him about the postmodern markets and what that means. He's Chief Global Equity Strategist over at Goldman Sachs, of course. We will also be talking to McKinsey's managing partner for Europe. That is Tunde Olanrewaju. That'll be an interesting conversation in the AI context as we go into the second half of this year. And before all of that, Jane Foley will be with us, Rabobank FX Strategy Head. Great person to look ahead to Warsh to think about what's going on with the yen.
Yeah, and the dollar dominance, of course, which obviously ties into yen weakness right now. So Jane Foley with her views coming up, of course, on the FX space. Let's look ahead at what else we are watching throughout the day then. Later today, Ireland takes over the EU's presidency. We will also be hearing about new measures to protect the EU steel industry from the unfair impacts, so-called unfair impacts of global overcapacity. They come into effect later today. We'll be speaking to someone close to that story as well, as Anna was saying. And at 10 a.m, we are going to be getting Euro area CPI inflation data for the month of June at 1:15 p.m. Meanwhile, we're going to get US ADP employment change. in June after jolts came in, suggesting that the labour market remains pretty resilient in the US. And we are also going to be getting the USMCA renewal decision at some point later today.
Keeping trade on the agenda for us. Coming up on the programme, thinking about trade, we will discuss the EU steel quotas. We'll be speaking to Axel Eggert, who is the Director General of the European Steel Association. As new rules come into play, what do they achieve? What still needs to be done? Plus, Nike shares slip in late trading after executives give a cautious outlook. We will break down those earnings from the world's largest sportswear company. Up next, we'll be joined by Jane Foley, Head of FX Strategy at Rabobank. We'll certainly talk about the yen and the strength of the dollar. If you have any questions, if you want to get involved in these conversations with Jane, with any of our guests, IB plus BBTV Go is the function to use. It is Wednesday, the 1st of July. How did we get here? This is Bloomberg.
The second round effect is probably going to take some time. What I'm really focused on is the indirect effects. Even though now, like fuel prices are falling, what we need to look at is how the 4 months of energy cost increases percolate into food inflation and into services inflation in particular.
So the origin of the shock has disappeared, more or less, before we see second round effects. I mean, there will be some, so that makes it, I think, relatively easy. We might need another hike, but I mean, in all likelihood, and that's of course what the market is pricing, but not as much as we thought in June. That's where we're going to have to calibrate our rate path. But I'm not concerned. I mean, I think this is more than doable.
European Central Bank policymakers speaking to Bloomberg about the inflation impacts of the Iran conflict and the rate path ahead at the ECB forum in Sintra. Fed Chairman Kevin Warsh, of course, will be speaking in Sintra this afternoon, giving markets a fresh opportunity to assess where he stands on the key issues facing the Fed. Bloomberg's Francine Lacroix joins us from Sintra. And Fran, of course, you have been speaking to those key officials, mostly so far from the ECB. What is the mood on the ground? Is it shifting a little bit more hawkish? What is your sense as to where things stand?
Yeah, the mood is shifting a little bit. So it was interesting yesterday because a lot of the panels here were really on AI and the longer term impact on productivity, on labor growth, and on inflation. But there's only one show in town today, and that's the panel this afternoon, the policy panel that includes Andrew Bailey, of course, Christine Lagarde of the ECB, the Canadian Central Bank Governor, and then Kevin Warsh. Now, remember, this is one of the first times that Kevin Warsh has come outside. And if you speak to insiders, not only from the Fed, but also economists, they're really quite unsure whether he's a hawk or a dove. Now, there is clearly a faction within the FOMC that are pushing him to try and be a lot more hawkish to make sure that there's a clear message to President Trump that they will focus on the economy and not what he wants, which is lowering interest rates. But it's interesting to see also how he positions himself. So far, he's been a bit of a politician because he's been so careful in his words in not really giving that much of an insight of where interest rates will go. The other thing you need to watch out for, Kevin Warsh, is that he may get a little bit of a boost because they're, looking at core PC a little bit differently. It's just something statistically that's changing from September. And so it means that core PC could go a little bit lower, making his job a little bit easier. So watch out for Kevin Warsh. There was also an interview yesterday with Andrew Bailey. He wouldn't be drawn into politics because that's, of course, a big story in the UK. But we could also get an idea of where he sees the path forward for monetary policy. And then you're right, Tom. Yesterday, we spoke to 3 central bank governors of the Eurozone, plus Philip Lane, chief economist at the ECB. And they say that it's a little bit too soon to look at the second round effects of inflation. So sure, the price of oil has gone down. If you look at gas prices, they've also stabilized in Europe, but they don't want to cry victory yet because you may have lingering inflationary pressures. Certainly, if you look at the long-term projection for inflations, they're above 2% for quite some time. And so the market really wants to try and understand whether there's a hike done for July or whether it's September. We heard from a lot of them that they don't want to be drawn into these conversations because they say, look, we're meeting by meeting and we're data dependent. But what's also very clear is that to some extent, they're relying on the market to tighten financial conditions. And by tightening financial conditions, it makes their job easier. If markets take out this, hike off the table, then it'll make their job a lot harder. So a lot to look out for this afternoon for that policy panel.
OK, great stuff. Bloomberg's Francine Lacroix on the ground for us at Sintra. Of course, Francine, thank you. And, of course, Francine will be speaking with more central bank leaders a little later on, including the Bundesbank president and South African Reserve Bank governor as well.
Let's think about Warsh and Kevin Warsh's appearance at Sintra and do it through the lens of currency markets. The dollar edges higher against all G10 peers as traders await central bank speakers at the ECB's forum in Sintra. We're joined now by Jane Foley, head of FX strategy at Rabobank. Jane, good morning.
Good morning.
Thank you for coming in to speak to us. So what are we thinking about when we're waiting to hear from Kevin Warsh? We heard a lot from him, of course, back home. More hawkish than had been anticipated, perhaps, and we had to reprice what was going on in expectations of rate hikes in the United States. Now he's making this kind of international debut, at least as Fed governor. What kind of focus will you have? What's going to be material for how the dollar responds?
Well, of course, as you said, we know that he was more hawkish at that last FOMC than the market had anticipated, but we also know that he doesn't like forward guidance. And from that point of view, I think perhaps we've got to really pull in our expectations about what he's going to signal, because he doesn't want us to signal. He doesn't want an awful lot of verbal intervention, if you like, from his colleagues at the FOMC. So it will be interesting to see his tone. We know, of course, he was a Trump appointee. Is he going to try, if possible, over the next 6 to 8, 12 months in order to bring in perhaps more of a dovish model? If so, what's he going to do? How is he going to do it? Is he going to try and examine the US labour market and pick up perhaps slightly weaknesses in some of those headline data? For instance, we saw this week that people aren't as confident about finding a job. So if we look at the vacancies and look at where the jobs are coming, they're not in all sectors. Yeah. Is he going to telegraph that, for instance? So there will be perhaps, I think, many people in the market looking for inconsistencies within what presently is deemed a fairly hawkish view from Warsh.
Yes, absolutely. And that, as you suggest, that hawkish view, understandable because of what oil markets have been doing, understandable because of what the market had positioned for ahead of that FOMC meeting. But this is somebody who, because of the president who appointed him, everyone had considered would come in with some more dovish approach. So do you think then is moving to a trimmed PCE where you take out some of the volatility, is that going to be the secret to enable Warsh? Or is it something in the task forces that enables Warsh to get to a more dovish place?
I don't know if it would be a secret moving towards a trim PC, because people are talking about it. I think the issue there is that if he were to do that, would it impact his credibility? And I think from a credibility point of view, credibility is essential really for all central bankers. And I think from a credibility point of view, what he did at the June FOMC, i.e. coming out a little bit more hawkish, was probably a clever move, because the data certainly at that point was looking a little bit more hawkish. The labour market certainly this year has been more resilient than expected. We were, in the midst of a very high oil price at that time. So I think it was the right thing to do. But going forward, now that we know that oil prices have come off, is he going to try and shift the needle a little bit, maybe with a view to trying to introduce a more dovish model along the road at some point?
Are you convinced that credibility has been restored, independence, and that story is done now, given the Supreme Court ruling and what we've heard from Warsh? Or is that still an open question?
I think it's an open question. I think it would perhaps be a little bit foolhardy to assume that it was closed, because he's only just begun his term. He's had one FOMC meeting, very few public appearances. And I think he's going to be judged on that for quite a long time, given we know that Trump wants interest rate cuts. So I think that is going to be a higher hurdle for him than most new Fed chairs at this point. So I don't think that question has been closed yet. OK,
interesting. And I'm thinking how that ties to what's happening with the Japanese currency that's under pressure again today. Right now, what are we looking at? 162, close to 163. So down again in session just by 1/10%. What's the next level for the Japanese currency? Is this sell-off looking a little over its skis at this point? How are you thinking about where this story goes?
I think it is. I mean, for instance, if we step back and look at some of the fundamentals within the Japanese economy, we look at the Tankan, for instance, that came out really very strong. We look at the strength of the Nikkei. That's telling us something about the strength of the Japanese economy too. We look at how the Japanese economy has been structured. It kept, when it had trade wars with the US over cars several decades ago, it kept a lot of the structure, the supply chains for semiconductors, which is really standing it in really good stead right now. There's been a lot of reforms. We've now got inflation in Japan, which means that a lot of retail investors can put money out of cash into longer dated investments. There's a lot going on there in Japan. And yes, I do think that the yen is undervalued. What I can't figure out is what is going to be the trigger to turn it around. And right now, I think the Bank of Japan does have a credibility issue because they have been hawkish for a while, and yet they've still been very slow in hiking interest rates. And there's a lot of people in the market that believe that is because of political pressure from the Prime Minister, which I'm not quite so sure about that. I think they were slow because there was the war, for instance. There was political pressure or political uncertainty in Japan at the end of last year. Can they pick up the pace of interest rate hikes? I think that is going to be a very interesting question this year, because if they can, that could be something that could help turn around the weakness of the yen.
I mean, would we go so far as to say, without the BOJ hiking more frequently, the Ministry of Finance can't handle this alone? They can't.
I would agree.
Yes. So they. The next step needs to be, or at least the big step needs to be from the BOJ. Can they move to a quarterly hiking schedule? I mean, if wages are rising faster than inflation, Jane, does that give them the cover and the political cover, if that's needed, for the politicians to make that move?
I think there's a lot of cover here. For instance, if we listen to the governor, Ueda, for a long time, him and others have been saying, look, the ageing population in Japan is an inflationary factor. We're running out of labour. That is going to put a bid in wages. But they needed to change psychology. And that psychology was moving it from a deflationary psychology to an inflationary psychology, where firms wouldn't try and cope with the background of deflation by cutting costs. They would instead enter into the scenario where what they've done now is putting up wages. And I think we are there.
Jane, thank you very much. Jane Foley, FX Strategy over at Rabobank.
Here's what else you need to know this morning. President Donald Trump has reported yearly earnings of at least $1.4 billion from crypto and meme coin-related businesses. The figure far exceeds income from his hotels and golf resorts. Trump also earned at least $26 million from new real estate ventures overseas. Schneider Electric has agreed to buy industrial AI firm Cognite in a $3.1 billion all-cash deal. Schneider says it will acquire 100% of privately held Cognite's share capital from Norway's Eggert and other investors. Schneider's move comes as European manufacturers increasingly implement AI across their factories to improve efficiency and streamline processes. And Nike shares slipped in late trading after executives gave a cautious outlook and warned about elevated consumer anxiety. Nike is facing pressure to produce results, with the company's stock down 36% this year. Investors' patience is being especially tested by persistent softness in Greater China, where results were in line with expectations but still down 12% from a year earlier. So there's the turnaround story that doesn't seem to be firing all cylinders for Nike, and then there's a question about the consumer. I'm pretty cautious in terms of what we heard from executive commentary about the health of the consumer, not just in China but in the US as well.
Yes, and in particular on the China story, Bloomberg opinion economist Juliana Liu writing about that 17% drop in sales in China and saying this is a lot to do with Chinese competition, and the answer to this is not restricting availability in China, which is part of the some have suggested Nike could do, but the suggestion here is more localization, more China-orientated collections, and that, they say, is, according to one opinion columnist, is the suggestion.
Because that's exactly what Chinese brands like Anta have done, and obviously done very well, and that is the competitive threat for Nike in the Chinese market.
Yeah, absolutely. So coming up on the programme, we will speak to Julian Lafargue, Barclays Private Bank. He will be with us to discuss how European stocks have just capped their best quarter since 2020. We'll talk stocks, we'll talk other assets as well. This is Bloomberg.
welcome back. We are 30 minutes from the start of the opening trade this Wednesday. European futures right now pointing down by 0.2%, but that's in the context of a strong session yesterday. Record highs for European stocks, up 0.8 by the close. Today, a little bit more caution as we look ahead to comments from the Fed's Warsh at around 2 p.m, alongside Bailey and Christine Lagarde as well. FTSE 100 futures pointing low by 33 points, down 0.3%. Over in France, a slightly brighter picture. The CAC current, well, very modestly, currently flat, actually looking to add just 1 point. That is the European equity markets futures picture. What's happening on the bond space?
Yes, well, actually on the bond space, we're seeing yields ticking up a little bit. We're seeing some selling of bonds, certainly at the 10-year horizon across Europe. It's pretty indiscriminate. It's across all of Europe, and we're seeing that kind of in keeping with slightly higher yields over in the United States. Yesterday, we saw gilt yields up by 4 basis points at the 10-year, and that was partly to do with some questions still, or reintroducing questions about how to fund defence. So we will be keeping an eye on that when gilt markets open at 8 o'clock, of course. OK, meanwhile, European stocks, as I mentioned, closing at a record high yesterday as the revival of the AI trade added momentum to a rally that's delivered the best quarter since late 2020. The S&P 500 also capped its best quarter in 6 years. Julien Lafarge is Chief Market Strategist at Barclays Private Bank and joins us now. Julien, good morning. Thank you for joining us. How confident are you in the European equity story at this point, given the movements around the Strait, energy prices slightly lower? Is this the moment for European equities to continue to build on the momentum that we've seen?
Yeah, we do think we're going to see an opportunity in the second half of this year for Europe to do well. They did very well starting the start of the year until the beginning of the war. And as the war started, then we had this massive rotation back to AI. We called in November for this rotation to happen. In our view, it's been delayed, not cancelled. And I think the second half of the year could mark a positive momentum for Europe. Now, I think we have to keep in mind, if we look a bit further down the line, that we're going to move into 2027, and at some point people will start worrying about French election and other political issues potentially in Europe. So I think it's going to be a short trading window for Europe between now and the end of the year.
OK, interesting. A short window. And what are the catalysts for that window to drive the gains further, even if that window is relatively short?
Well, I think you have to. You have the reopening of the Strait of Hormuz. Obviously, Europe was most impacted alongside emerging market, but Europe was impacted by that. And the second will be if we do see what we believe we're going to see, which is a broadening of the leadership in markets, i.e. not so much focused on AI or solely AI. Europe screens relatively cheap. It's a bit of the AI, anti-AI trade at this point. And we think that could also appeal to investors, simply because US equity valuation aren't necessarily that appealing. As you said, we've had a fantastic quarter. Looks a bit overbought at this point and maybe overowned. So that's where we think the catalyst could be.
Julian, good morning. And you've been talking about the AI trade evolving from exposure to execution. And is that where Europe can get more out of the AI trade?
Yeah, exactly. And I think also, we talked about the next 6 months, but if you look at the next few years, Europe clearly has its opportunity there. Yes, we don't own in Europe the most advanced frontier AI model, but we're pretty good at everything that is industrial, manufacturing, etc. And so if you think about the next step of AI, which could be physical AI, I think Europe has a clear place and a role to play there. So in our view, you shouldn't dismiss Europe. Europe is always more of a trading market because you always have, like we mentioned with France election coming up, some concerns emerging. But we do think there is a space for Europe, a place for Europe within the AI trade, which we expect to broaden in the next months, maybe years.
Yes, and I noticed from a sector perspective, you like tech or IT, and you also like healthcare.
Yeah.
That's a sort of has a barbell feel to it. I mean, what is healthcare acting as a protection against something that happens with tech, or what's the strategy there?
Well, it's more thinking about, okay, we've focused so much on the infrastructure build-up. What's the next stage? And look, markets have generated a huge amount of value with this infrastructure build-up. But for us, this is just a fraction of what we could see if AI turns out to be what we expect it to be. And then, so we're thinking about which sectors, next sector, will be able to benefit. And one that is obvious in terms of being able to implement AI relatively quickly, because it's already the case, it's healthcare. Whether you think about drug discovery, diagnosis, it's already happening. So for us, Healthcare is also playing on the defensive side, a sector that has underperformed. But it's also thinking about the next leg of the AI trade.
Yes, I mean, and actually, just on that subject, we had news out of Anthropic, didn't we? Just in the last, I think it was just the last 24 hours. Yeah. Claude Science being released, which is to automate biology, chemistry, all of those kind of tasks, which.
Drug discovery is clearly part of something that they're aiming at. You saw some of the listed companies in the US falling in the back of that announcement from Anthropic. So that's an area that you're interested in. I'm just wondering, in terms of, you talked about this short window. I want to take you back to the European stock story. A short window. Why is it a short window? What kind of derails Europe in 2027?
Well, usually, and that's a feature of not the bug of the region, but politics will. And again, the French election for us is going to be, the campaign is going to start early next year, and that's probably going to keep away some global investors, because there is always this risk as to which party is going to dominate. We know that Macron cannot run again, so you're going to have a change in leadership in Europe. So we also know that France has some issue when it comes to sovereign debt and their level of debt. So that could be an issue, we think. And the other one is, Europe is a very open economy, and so it will be at the mercy of anything happening globally. And we are in a very complex world these days. We've seen what happened in the Middle East, that's one, but anything else could happen, and Europe will, by definition, be impacted because it's such an open economy. So that's why you always have something happening where people will question, can Europe actually outperform over the longer term? So for us, it's more of a trading opportunity rather than saying we want to own it for forever.
Yes, and with that in mind, the French elections and the other electoral events coming, and the focus on the fixed income and the fiscal challenges that Europe has. I mean, do you like fixed income? I noticed that where you do like fixed income, you like it for carry because you like the yields. They're giving you more than inflation in a lot of places. Does that apply to European government bonds? Is that the strategy there?
Yeah, it's one area where we do see opportunities. Is it Europe that we prefer? Probably not. I think you see better opportunities in emerging markets in particular, simply because you do see fundamentals that are, in many cases, stronger than in developed markets. But there are opportunities in Europe. In the UK in particular, we think we could see good entry point if we do have a bit more of a political noise through the summer.
On gilts?
On gilts.
Right.
Yeah.
So that brings the price down, and that's the good entry point.
Exactly.
But you're not worried about the fiscal sustainability questions that
no,
might raise?
I think, look, the market may have its moment and be a bit scared about the next step in UK politics, but for us that would be an entry point rather than something that we would run away from.
What level of yields where would you end that trade? I mean, is it kind of anything above 4% on the 10-year looks good to you? How are you thinking about
on the UK
on gilts? Yeah.
On gilts, yeah. I think if you get closer to 5, I think you close your eyes and you just go for it.
So we're at 4.75 right now on the 10-year.
Not far.
Yeah, we're not far. Anything above 5 for us would be a good entry point. Again, you have to understand why exactly we get there, right? So it depends on what is the catalyst for this spike in yield. But assuming there is no big change for us, anything above 5 is a clear entry point.
And politics more important than the BOE right now for gilts? And you assume the BOE stays on hold?
Yes, that's our view. I mean, look, like any other central bank these days, it's a bit of a question mark, and depending on what happens over the last, I don't know how many days we have left, 50 days or so. But for right now, it's more of a fiscal question than anything else in the UK.
Julian, thank you very much. Thank you for joining us. Julian Lafargue, Chief Market Strategies at Barclays Private Bank. And a special congratulations for joining us as I think you stayed up to watch the French game.
I did, yeah.
Yes, and it was worth it.
It was.
Excellent.
It was worth it coming as well. Anyway.
There's nothing worse than staying up to watch your country go out on penalties. We can say that.
Nowhere near close to that last night for France. 3-0.
No.
3-0.
Absolutely impressive. European central bankers then are warning about the impact of the Iran war on inflation and on growth.
This energy shock has been clearly stagflationary, not like in the 1970s, that was a very deep stagflation, but its nature is of similar kind in the sense that at least in the short term, inflation has increased while growth outlook has weakened.
That was Olli Rehn, the Bank of Finland governor and ECB Governing Council member, of course, speaking to Bloomberg at Sintra. We will have more from the forum throughout this morning as we work our way towards that panel featuring Kevin Warsh later on today from Portugal. Meanwhile, this is London. This is Bloomberg. Welcome back, everybody. This is the opening trade. 17 minutes until we get that opening trade, and the European equity market picture looks a little bit sluggish this morning. Maybe the DAX outperforms a little bit. That would be in keeping with yesterday, where technology stocks were the best performers, industrial goods and services, that all played to the strengths over on the DAX. US futures are pointing weaker, and Tom, NASDAQ futures down by 0.4%. So it does look as if a little bit of uncertainty around the technology sector is warranted, perhaps, in today's session.
And continued uncertainty, frankly, about what's happening in terms of the US and Iran as well, with negotiations, of course, taking place yesterday. The US says negotiators Jared Kushner and Steve Witkoff had positive discussions with regional leaders in Doha on a deal with Iran. It comes as the Wall Street Journal reports President Trump has been briefed on options to return to all-out war against Tehran. Let's get more and bring in Bloomberg's Abu Abir Omar, standing by in Dubai. Abir, what is the latest?
Good morning, Tom. So look, what we know is what essentially you had just mentioned is that the talks that happened in Doha had gone on a positive trajectory. This is according to Bloomberg sources. Now, Steve Witkoff and Jared Kushner, President Trump's son-in-law, were in Doha yesterday negotiating those unofficial talks with Iran, with Qatar, one of the main mediators, being obviously present at the table. The Prime Minister of Qatar also holding talks with both Trump's top negotiators. What we know is that the talks had gone positively. We don't have a lot of clarification on what exactly that means, but I guess a step towards a better place than what we've seen over the past few months or so. Now, what we have from the Iranian side, and this is according to the top negotiator from the Iranian side and the Speaker of the Parliament, Ghalibaf, who's been on top of those negotiations over the past few months or so, he said that about $12 billion of frozen assets are in the process of getting released. Oil sanctions are lifted, and Iran is able to sell its oil at a premium. Now, we don't have confirmation from the American side on these notions that he had mentioned, but what we know for a fact from both sides is the contention around the Strait of Hormuz, and that is a topic that's taken shape over the past couple of days, Tom, and it's about Iran saying, or being really adamant on tolling the Strait of Hormuz once the negotiation period over the 60 days is over. The U.S., through the Secretary of State Marco Rubio last week in the GCC, saying that is completely unacceptable. Iran saying acceptable or not, and whether with the help of Oman or not, they will charge the Strait of Hormuz once the 60-day negotiation period is over. Now, that's caused a little bit of caution with the movement of ships and tankers through the Strait of Hormuz over the past couple of days, but we're still seeing movement there. Both Morgan Stanley and Goldman Sachs coming out saying an oversupply in the oil market is something that is expected to happen. Morgan Stanley actually bringing down its average oil price estimate to $75 a barrel for both the third quarter and the fourth quarter. But when it comes to the wider negotiations, we continue to monitor and see just the trajectory of them. President Trump, as you had mentioned, a Wall Street report through their sources suggests that he is choosing to go down the diplomatic route, even if the negotiations have to go beyond the deadline in August after the 60 days and not do a full-on back-to-war intervention there. And so, again, something we continue to keep an eye on, and whether those discussions take a different shape in a different country over the next couple of weeks or so.
Abir, thank you. Abir Abu Omar, keeping us up to date on the talks that take place. She's in Dubai, and we thank her for the update there. Oil price is pretty stable, actually, this morning. Let's turn to today's markets in 3 minutes on the opening trade with Markets Live executive editor Mark Cudmore. Mark, what might not be stable in the next 36 hours or so is, well, a whole host of assets watching what we get from Kevin Warsh and then preparing for a public holiday in the United States. So give us a sense of what it is you're going to be watching for from Sintra, from Warsh and the other assembled central bankers over the next day or so.
I think the backdrop for July is very positive for stocks if we get through the next 36 hours. So a lot of it is about analysing it through the lens about when will be your opportunity to maybe to enter more kind of bullish views. I say it in the perspective that we're getting clearly strong growth. We seem to have moved beyond the Iran conflict. Oil prices have retraced a very long way. We're getting still large capital expenditure from the private sector, as well as fiscal injections from state sectors globally. So I think that the overall backdrop is relatively good for stocks into an earnings season that I expect to be generally supportive. Now, in the short term, as you said, we've got Sintra, which is a risk. I think we'll get through that risk, but it is a risk. Now, because of the way rates have moved in the US over the last week or so, it is much more two-way risk, which makes it interesting. And then there's non-farm payrolls tomorrow. Now, if jobs data tomorrow is strong, that'll probably see rates jump up again, and you know, it might disrupt stocks in the short term, especially at the low liquidity. But ultimately, people will go into next week kind of going, hey, the only reason we're going to get higher rates is because the economy is very strong in the US, and that is ultimately a tailwind for stocks. So that'll be the outcome, which is maybe short-term negative, but ultimately positive. On the flip side, if we get, you know, a negative non-farm payrolls number, we might again see a little bit of nervousness that, hey, wait a sec, are we seeing slowing growth? But then very quickly, or maybe over the next week or two, we'll see rates come down a lot lower, because then it'll allow Warsh to be subsequently dovish, no matter what he delivers today, and that will support stocks. So really, it's about a timing. Do stocks rally from the end of this week? Do they rally from the start of next week, or do they start rallying a week from now? But overall, I think the backdrop for July is positive once we get through this tail risk. First up, of course, is Sintra. I'm not expecting something to happen, but we should be very prepared, because people will overinterpret anything Warsh says.
Okay, so be on the ready for any overinterpretation of the verbiage from Warsh. As you think about that potential rally then going forward, Mark, is the concentration risk story behind us? Does this become a market that has more breadth?
I think it's no to the first and yes to the second, in terms of I think we will get more breadth in the rally, because I think this is going to be a rally in July on the fact that growth is still holding up, and I think that's going to be supportive for a wider kind of part of the economy. But ultimately, everything is still dominated by the AI theme. We still have an AI capex bubble there. Part of the strength in the economy is the capex bubble from AI. So, ultimately, that is still going to be the dominant factor. And we can't have AI sector, struggle or collapse and the rest of the economy make up for it. So I think the breadth will widen out during the good times. But I think that if AI has a swoon at any point, that will drag the whole market down. So we still have that massive concentration risk, even as breadth will widen out over the next month.
OK, Bloomberg Markets Live Executive Editor Mark Cudmore, thank you. Remember, you can get up-to-date analysis and insight from Mark and the rest of the team. Just go to MLIV Go on your terminal. Let's bring you Chloe Mele now, who's standing by with your stocks to watch this Wednesday. Chloe.
Good morning, Tom. Let's start with sportswear this morning, because Nike over in the US has given quite a cautious outlook and has warned that the consumers are under a lot of pressure at the moment. So this will add to existing investor anxiety around that company specifically. But we could also see some read across over in Europe for some of those sportswear stocks that we have here, especially Puma, Adidas and JD Sports will be in focus today, especially given the fact that this is not a company-specific problem that Nike has mentioned. This is very much about that broader environment. Moving on to Schneider Electric, which has bought a company, an industrial AI company called Cognite, for $3.1 billion. This is part of this drive among industrial companies to really integrate AI onto the factory floor to boost productivity. We could see this acquisition lift the shares this morning for Schneider Electric, has been one of the big beneficiaries of this huge spending on AI infrastructure. It is worth noting, we've got this quote here from JP Morgan, that M&A at Schneider always makes them wince upon announcement, but that it has proven strategically astute often. So we'll be watching out for any impact and reaction there. And finally, more M&A over for Shell, which has agreed to sell its stake in some US oil assets for $1.7 billion. This is part of a strategy of reshaping the portfolio. It's not uncommon for those super majors to sell those aging assets and refocus that capital on newer projects. So this could be that happening there. And we have seen actually Shell underperform BP by quite a large margin over the last year. So we'll see if this selling of its stake is enough really to lift the shares this morning.
Chloe, thank you. Chloe Melly with the stocks to focus in on. We'll look for any read across from the Nike numbers into sports manufacturing companies here in Europe. And sometimes it's a read across in a positive sense because what one loses, the other gains. And sometimes it's a negative. You know, if one loses, the others are seen to be exposed as well. So that's one sector that could be in focus. But it's interesting that the US futures are pretty negative and the Asian handover has been pretty sluggish. So it's as if we don't quite have a new narrative to get our teeth into this morning here for European stocks as we wait for Warsh.
After those record highs for European stocks yesterday, and tech played a big role, so we'll watch ASML and see if that company performs well again today. I'm interested in the miners, given what we're seeing in copper, iron ore, gold and silver, all under pressure, and it's worth noting that the gold is on track, or has had its worst quarter, in fact, in more than a decade. More than a decade, gold. So that's part of the kind of retail frenzy has fizzled out, but also the fact that the dollar strength is there as well. And so obviously that pressures.
Absolutely.
gold.
And that also reflecting the changing thinking around the Fed. So if you get Fed hawkishness, of course, then the opportunity cost of holding gold, you reassess that. And so as a result of that, we've seen some weakness in the gold price, and gold is at 3,973. Pretty flat on the oil price as we watch.
Relative stability. So do you want to be on the sidelines, essentially, ahead of Warsh and ahead of the non-farm payrolls data?
Well, Mark was telling us the next 36 hours, there's a lot of risk in the markets. Then he's more positive on what happens in July proper. This is July, of course, 1st of July. But he was saying the next 36 hours, we have a number of risk events. We have to get to the end of this shortened US trading week before we kind of look ahead. But, yeah, hearing from Warsh on the international stage will be part of that narrative.
European futures currently pointing down by just 0.1% coming up. It is the opening trade. Futures pointing lower, as I mentioned, but not by huge amounts. Stay with us. This is Bloomberg.
Welcome back, everybody. A few minutes to go then until we get that opening cash trade here in Europe. And the picture, as painted here in the US session of yesterday, would look like a positive one. European equity markets closed where this yellow line is, and then we saw some modest gains coming through, or more than modest gains coming through on US markets after that point. So that you would have thought might provide us with something of a positive setup. But then the Asia session looking a little bit lackluster, and Europe did quite a lot with the tech trades yesterday. So maybe we've got all we can out of that for just the moment. So futures are looking a little bit sluggish. Last time we checked in on them, it seemed that the DAX would outperform. There we go. DAX futures perhaps outperforming a little bit. FTSE futures will look for energy and basic resources to be a driver of maybe some of that weakness coming through there. So that's the picture across these European futures then, looking flat to negative really, Tom, as we wait for a number of risk events. We've got, Kevin Warsh speaking later on today, and then we get the non-farm payrolls number tomorrow, not Friday, tomorrow, Thursday. And so all of those risk events still ahead of us for stocks.
Some interesting individual corporate stories as well to focus your attention on this morning. So we had that caution coming through from Nike on the back of their earnings. Certainly executives not painting a particularly bright picture, and China as a market is a challenge. So we'll look at the sportswear stocks in Europe to see what the read across there is to what we heard from Nike. So companies like Adidas, of course. AB Foods, the owner of Primark, reporting falling sales at its Primark budget fashion chain. That's as the group prepares to separate actually clothing and food division. So we look at AB Foods and Schneider Electric with a deal around the AI space to buy Cognite. So we'll see how investors react to some M&A as well from Schneider Electric, Anna.
Yeah, a little bit of M&A, a bit of asset sale, some asset sales taking place from the energy space to that Schneider story that you were just mentioning there, Tom. So we'll see if those individual corporate stories cut through, or if this is a day where we are just sitting on our hands and waiting for Kevin Warsh to speak. Of course, we've heard already from him, notably that more hawkish than expected FOMC meeting aftermath, but we haven't heard from him very often in the role as Fed chairman. So we will certainly be looking for all of the context and everything that he gives later on the stage at Sintra. So the European equity markets then just getting into their stride this morning, and it's not a stride that's going very far right now. It's the FTSE 100 that's pretty flat, a stock 600 that is just on the back foot, down 0.1%. The AEX, the IBEX, and the CAC 40 down by 0.2%. So we're not seeing a huge amount of movement. Yesterday, tech stocks did pretty well in Europe. At least they were the best performing sector across Europe. That played well for the Xetra DAX. Will we see another day of that? The DAX is not yet open. Tom, what do you see in the sector picture?
Yeah, all of this in the context, of course, of record highs for European stocks yesterday. At the top of the list in terms of the gains coming through, chemicals up 0.9%. Autos also gaining 0.6%, despite the challenges, of course, in that sector for Europe. On the downside, as we had expected, basic resources then, as a result of what we're seeing in terms of iron ore, copper, and gold and silver down in terms of pricing. So basic resources is the biggest hit right now in terms of sectors, with drop of 1%. So that is down 1% so far in your sectors. Media also taking a bit of a knockdown, 0.9%, and energy lower as well. We talked about the relative stability in oil prices so far in the session today. Energy is down 0.4%. Again, the gains coming through for chemicals, autos and telecoms, but most sectors are now in negative territory, Anna.
Yes, most sectors are, aren't they? And that chemical story and autos and parts, maybe that still plays well for the German market. So we'll certainly look for that one to open up. Still closed over on the Xetra DAX. As you say, basic resources, media, some of the worst performing sectors today. In terms of the individual stocks on the move, Schneider Electric is one of those that you flagged a moment ago then, Tom, because of that deal. And that stock is down by 2%. We're also watching some of the mining names a little bit weaker. Glencore, Rio Tinto, for example. And to the upside, SAP, that's interesting, isn't it, after the weakness that we've seen in software stocks and hyperscalers and the gains we've seen in chip stocks in the first half of the year, or certainly the second quarter of the year. Let's turn our attention then to where we go into the second half of this year. Peter Oppenheimer joins us, Chief Global Equity Strategist over at Goldman Sachs. Peter, great to have you with us. Thanks for being
Anna.
with us. Let's think about, look ahead a little bit, I suppose, to what we expect to see from here, because we've seen some really fascinating dynamics within the tech space in the second quarter of the year. The market's managing largely to look through a lot of the geopolitical tensions. How does that set us up on July the 1st for the second half of 2026?
Well, Anna, look, I think it's been an extraordinary first half of the year, and a lot stronger than I think many people would have imagined, given the macro backdrop and the uncertainties that unfolded. But that's really down to earnings being very strong. And I think that's going to continue to be the case and what really drives equity markets in the second half. We don't think valuations are really going to go up from here. But really, they didn't do much in the way of contributing to returns in the first half either, or indeed since last year. So as long as the earnings continue to be good and to broaden out, I think we'll get continued gains through the second half, probably lower than we saw in the first half, but I think it will be quite broadly based. And that should be a good environment for investors to enjoy a diversified, balanced return.
Yes, and what's going to be driving that earnings story then in the second half? I mean, different things in different sectors, I'm sure. We focus a lot on technology and the incredible profits that some global tech names, particularly in the memory space, have managed to make in the first half of the year. What drives the earnings story then into the second half?
Well, I think it's two things. Technology is still a key driver of earnings growth. If we think about the S&P, for example, going into the second quarter, expectations are over 20% growth year over year, stronger than the first quarter, and about 60% of that is expected to come from actually the hyperscalers.
Right.
Now, they have underperformed.
Yes.
They've actually derated, but
they
the earnings are still...
They
weren't rewarded for that, because investors are looking at longer-term future, potentially slower returns. You said the same in software as well. The performance has shifted to hardware, but broadly across the tech space, you're still getting very good earnings growth. I think that will continue. But also important to say that this massive ramp up in spending that the hyperscalers have been doing has been, and I think will continue to trickle out into some better earnings growth into other sectors, which are really helping to support that infrastructure build out. And that's why we are seeing a bit of a broadening out, and why actually Europe, as you mentioned, has been holding up well. In fact, the first half of the year doing it as well as the S&P, despite having much lower exposure to technology.
It's quite an amazing statistic, isn't it?
It is.
Since the beginning of the war, slightly different, but if you go back to the start of the year, Europe holding up as well, despite all of our focus on AI.
What is your level of conviction that European story continues? Is there a rate risk if the ECB officials are sounding pretty cautious right now in terms of second round effects on inflation? Do interest rates derail the story? Do politics derail the story? We were speaking to a previous guest at Barclays saying there's a 6-month window for further upside for European stocks, and then 2027 is a very different story.
Well, Look, I think the first thing is that there's still a valuation advantage that Europe has relative to other markets, even when you sector adjust. So when you look at comparable companies in Europe, they tend to have a lower valuation. It's true, on average, they tend to have lower growth rates, but, profits are holding up really quite well. And I think that will continue. So from here, given that we don't expect rates to be trending down, although we do expect them to come down again next year, the main driver of equity markets is going to be profit growth through the remainder of the cycle. I think Europe stacks up reasonably well. It has been the weakest of the major markets since 2025, but only marginally weaker than the US. And when you consider that so much of the focus has been on technology and Europe has lower exposure, that is a reflection actually of many of these other areas that Europe has exposure to in the value space, actually generating pretty good cash flows and shareholder returns. I think that will actually continue. So I do expect more moderate index gains, but still Europe making some decent progress.
And you talked about and reflected on that hyperscaler spend and how that is broadening out in terms of other companies benefiting from that. And Europe does play a role there.
Yes.
With those names that connect to the energy, the infrastructure piece, and the support around data centres. Where are we in that story? I mean, that for some that's been clear for a while. Is there still a place? Is there still further significant upside for European companies that play in that space around the infrastructure story on AI? And how should investors be thinking about getting exposure to that?
I think there is. We're still in the relatively early stages because there are two combining drivers of what I think really is a super cycle in capex and investment spending. One of them relates to the whole build-up of infrastructure around AI, the first major infrastructure build-out in technology since the commercialization of the internet more than a quarter of a century ago. But remember, that's also coinciding with governments around the world, including Europe, borrowing more money to spend on critical infrastructure, increasing or improving the robustness of supply chains, of energy capacity and supplies, and also, of course, on defence. So it's a combination of these two things, I think, which are going to continue for some time.
And Peter, that is a feature of what you call the postmodern cycle, because we've been through, in your terms, in your notes, you talk about the traditional cycle up to the 1970s, the modern cycle, 70s to the sort of 2010s, and then since the pandemic, this postmodern cycle, which on the one hand sounds challenging because it's away from globalisation and all the things we understood at the beginning of the century, but you say that actually that throws up alpha opportunities because of this investment in critical infrastructure and all kinds of other things that governments and companies are having to do now.
That's right, Anna. I mean, we first started to talk about this postmodern cycle 4 years ago because we were recognising that apart from the shorter-term cyclical factors, there were some secular shifts beginning to emerge. Less globalisation, more regionalisation, an increase in government borrowing and spending, a rise in inflation and interest rates. Over the last 4 or 5 years, remember, long-term interest rates have moved dramatically. We had German, Japanese 30-year yields at around zero just 5 or 6 years ago. Now, 3.5% to 4%, massive change. But alongside that, massive changes and upscaling of innovation in technology, also a shift in the priorities of governments, and that's increasing the prospects of a super cycle in capex, which is actually broadening out the investable opportunities for investors. But again, I think increasing the focus on alpha relative to beta. I think valuations are going to be less of a driver of returns compared to the last 10 or 15 years.
Investors might have been concerned about a pivot to this postmodern era, as you describe it, if it featured higher inflation, higher cost bases, higher yields. But you don't paint a picture where those things necessarily worry too much.
Well, I think there is certainly concerns. I mean, governments are borrowing a lot of money. That is pushing up the cost of capital, and I think that does increase the differentiation between companies that can easily cover their cost of capital and those that increasingly over time will not. That's why alpha, I think, is going to become a more important driver of returns. But on the other hand, I think that while that creates a challenge and potentially a risk if bond yields rise much further, we are getting these new drivers of growth, and they're, in the last sort of 10 or 15 years, there was really an excess of global savings and not that much to do with those savings because growth rates were very low, inflation was low, nominal GDP was very weak. Now there are many opportunities to invest, and that's creating the opportunity to pick stocks and to differentiate much more.
Peter, where does the UK and UK stocks sit in that story, whether it's the large caps or the small caps, the mid caps? Where do UK equities sit in
Well, I think they fit very well in the value space and a very important part of a global diversified portfolio. It's a small market now, but it is very cash generative. It's got the highest free cash flow yield of any major market in the world, at around 5.5%. It's made up of lots of sectors which have a very high shareholder return because you have a high dividend yield and many companies are buying back stock as well. And so even with relatively low growth, there's a very strong value case, I think, to be made. It's one of the cheapest markets. But of course, there are significant sector skews. There's no major tech stock in at least the FTSE 100. And the FTSE 250 and the broader indices, of course, are much more domestic. But I think there's a lot of innovation in the UK, and there are a lot of very attractive mid and smaller sized companies. They lack a bit of liquidity, but again, that's one of the reasons why we're seeing a big pickup in M&A, and I think you mentioned that earlier on. That's a trend I think that will continue.
Acquisition targets, maybe. Peter, thank you very much indeed. Always enjoy your insights, always valuable for our audience. Peter Oppenheimer, Chief Global Equity Strategist at Goldman Sachs. Let's check in on the core 6 European stocks right now on this Wednesday trading session, 12 minutes in. You're looking at ASML that performed strongly yesterday, down 0.6%. The gains are coming through, interestingly, for Rheinmetall in the defence space, gains of almost 2% there. Schneider Electric on that acquisition story, talking about acquisitions, currently down 2.4%, and largely unchanged on Novo. A little bit of downside pressure in the luxury space, LVMH down 0.8%. Let's check in on some of the other individual stocks on the move and bring in Chloe Melly. Chloe.
Good morning, Tom. So let's start with this M&A story then. So we have got Schneider Electric buying the industrial AI company Cognite from Aker for $3.1 billion. And so we are seeing that driving the shares higher for Aker, but then driving those shares down actually for Schneider Electric. This is an acquisition that will give it a deepening expertise into the industrial AI sector, but maybe the price tag is a little bit of what investors are objecting to this morning. So we're seeing a little bit of weakness there. We are also seeing some weakness in AB Foods, which has reported falling sales at Primark, and this is ahead of this demerger of the clothing side of things. So that's Primark and then the food arms as well of that business. And so this means that perhaps it might be quite difficult for Primark to command the kind of premium valuation that Inditex or Next have, for example. And so we're down about 2.8% on the back of that this morning. Moving on to Air Liquide, which is a company that makes industrial gases, and it is up almost 2% this morning after saying that it will build 2 US production units to supply SK Hynix, the South Korean tech giant. So that is the way that Air Liquide is able to kind of get into on that AI boom. And so we're up a little bit there. JD Sports is seeing some weakness this morning on the back of that Nike read across, with Nike mentioning that consumers were under a lot of pressure and giving that quite cautious outlook. And so we're seeing that read across there into Europe for JD Sports. And finally, let's end with Symrise. The ingredients company has been placed on a positive catalyst watch by Citi analysts, with the analysts saying that the recovery in European ingredients in that sector has further to go, and that Symrise is particularly well placed. And so we're up about 2% this morning for that company.
Chloe, thank you. Chloe Melly with some of those stocks that are moving this morning. Coming up, restrictions lifted. The US government has removed foreign access curbs on Anthropic's Fable 5 AI model. We'll get the latest details next. This is Bloomberg. Welcome back. This is the opening trade. We are 18 minutes into a European session that's actually just on the back foot now. So even the DAX now down by 0.1%. When we look at the sectors that are leading things around today, we see most sectors are in negative territory. Basic resources, media, consumer products and services. So a mixed bag moving lower. We've seen chemicals and telecoms actually a couple of the only sectors moving higher. But let's move on to the bond markets, because we've got some interesting moves there where yields are a bit firmer, and so we're seeing some selling across the curve, it seems, across European government bond markets as well. So the UK, we saw higher yields yesterday. Now we see that in the rest of Europe as well. So it's not just a UK phenomenon. It seems to be all over the European bond market space, partly to do with perhaps higher gas prices. That is something that some people are citing, and we have seen a 2% jump, now not much, not 2%, but 1.8% higher on TTF, the gas benchmark in Europe. So perhaps that is something to watch then, Tom.
OK, on the tech front, the US lifting foreign access on restrictions on Anthropic's most powerful AI model. The move clears Fable 5 for wider global use after the startup resolved the Trump administration's safety concerns. Anthropic says it will begin restoring access very soon, potentially as soon as today. For more, let's bring in Bloomberg senior strategist Neil Campling, who's been watching this for us. Neil, just unpack the kind of the detail behind this decision. The export controls were put in place in June. Now they've been removed, it seems. What is the background to this decision?
Morning, Tom. Yeah, the background really is that there were some safeguards around risks around cyber attacks by bad actors using these frontier AI models. So the government had national security concerns. So with these easing of restrictions, clearly they are happy that the new safeguards are in place that blocks behaviour that could potentially bypass some of the protections. And that's what triggered the administration's move in the first place. So it's definitely a positive step forward. And I think really importantly, the lifting of the restrictions basically means that the US can basically keep pace with China's AI development that really has come on substantially in recent months. And again, with OpenAI facing similar treatment last week as well, then again, it looks likely that we are now in a place where the frontier models are deemed safe to use in widespread use, which is obviously really important in terms of the AI race for in the battle against China to make sure that the US leads in AI development.
So that's the frontier model side of things. Other news out of Anthropic then, Neil, is the launch of a research tool. I think this specifically aimed at science research. What do we know about that?
Yeah, so this is an interesting development overnight. It's yet another one of these agentic agents, which Anthropic have been very successful in launching in a range of industries in recent months. What this one does in terms of it really helps scientific research, and as we know, AI industry leaders have talked a lot about curing diseases, a major potential upside of the technology. And pharma companies with very deep pockets can also help to facilitate the acceleration of these developments. I think the other thing to bear in mind that until now, there's only really been one tech company that has had global leadership in this area, really, and that's been Google's DeepMind. And overnight, effectively, Anthropic has closed and perhaps even advanced DeepMind in terms of the abilities here. So it's a space to certainly watch in terms of the developments going forward into science, research and healthcare.
Neil, let's zoom out a little bit and just reflect on the quarter that was, and particularly the gains that came through for the semiconductor index, maybe at the expense of the hyperscalers, and certainly that was a dynamic we saw. What lessons do we learn from that as we tiptoe into the next half of the year?
Yeah, so great question. We clearly saw Mag 7 and the hyperscalers kind of become the funding trade for investors to put money to work in the picks and shovels into the semiconductors and the semi-equipment stocks. It wasn't just the memory trade. There are more than 10 companies in the benchmark SOX index up triple digit in the quarter. Interesting as to where the next leadership comes from, because the worst performing stock in that SOX index during the quarter, which was up, as you mentioned, 89%, was actually Nvidia. It was only up 15%. So again, reflective of the rotation into other plays in this space. And it'll be interesting to watch in Q3 whether that momentum continues or whether there'll be other parts of the AI trade in terms of energy, infrastructure, that sees rotation of investor dollars. But I think we'll need to get into the earnings season, and in particular what happens in terms of CapEx guidance from the hyperscalers to get a sense of what the next trade is for AI from here.
Neil, thanks very much. Bloomberg's Neil Campling with an update on some of those tech names. Let's have a quick look at where we are on the sportswear stocks here in Europe, because they all seem to be under pressure, and this is very much linked to the Nike story. After Nike executives gave a cautious outlook and warned about elevated consumer anxiety, adding to investor concerns about the slow turnaround at the world's largest sportswear company. Bloomberg opinion columnist Andrea Felstedt has more on the story for us. And I was going to ask you if this is all Nike specific, but it does seem to be having a bit of read across into other companies, so maybe not all of it. What's your takeaway?
No, I mean, some of the factors that are affecting Nike are broad across the market. One of the things is we have got this slowdown in sort of sports-inspired fashion. We're seeing a return to sort of smarter dressing, which is affecting Nike. Nike's what they call sportswear. It's sort of anything that's not performance. And Adidas has, been a really good performer. But Adidas is seeing the same things. I think you've got that broad trend across the market. Plus, all of them are facing these sort of nimble rivals. So Nike is having a much harder time than Adidas. But some of these factors are general across the market.
Some of our viewers may have noticed that it's the World Cup right now. So reflecting on the 3-0 win for France against Sweden overnight. This is important for the fashion brands. It's really, they kind of have to pick. They kind of have to pick their teams before the event, and they're placing their bets, essentially.
Absolutely, and Nike's done very well in that respect. It's got France, if I remember rightly, so It's got Kylian Mbappe. Football's not my natural habitat.
No, you're right.
You're doing very well, Andrea.
It's got Erling Haaland.
We're here with you. Yeah, he's good. He's
Vinicius Junior. I've probably said that completely wrong, but it's got some top players. It's got some top teams.
Yeah.
I think its World Cup campaign has actually been very good, and it's showing some sort of flashes of past Nike brilliance.
Right.
So I think how they've executed the World Cup is very, very encouraging. Everything they're doing, if they can get some good momentum with the teams, good momentum with the players, I think it's going to be very positive for Nike, and investors should take this as an encouraging sign that the turnaround is working.
So that's part of the turnaround, and that seems to be playing out well for them. But you mentioned about the nimble competition, and in China, that's getting a lot of attention. Is that the Chinese rivals are not making enough specifically for the Chinese market, including more sneakerinas?
Exactly.
Which I just wanted to say.
Exactly. It's not localising enough, and it's not tailoring enough for the Chinese market. It was talking this morning about elevating and being more premium in China. So that's clearly the way it's going.
Andrea, thank you very much. Thank you very much indeed. We don't have time to get into what a sneakerina actually is, but we'll get you back on for that.
Next time we'll bring
Anna
pictures.
managed to say her favourite word
yes,
of the
next
day.
time
Bloomberg
we'll bring
opinion.
pictures. The name tells you everything. It's a combination between a ballerina and a sneaker.
Should I? Yeah. Andrea, thank you very much indeed. Andrea Felstedt, of course, from our Bloomberg opinion team on the fashion space, and the overlink, of course, with Spain. Coming up with sport. Coming up, Axel Eggert of the European Steel Association, that's quite the shift, isn't it, is here to give us his take on the EU's decision to cut its tariff-free steel quota for close trading partners. That is coming in today, that decision and that policy. That is next. This is Bloomberg.
Welcome back, everybody. This is the opening trade, 30 minutes into our session here on the opening trade. And European equity markets flat to negative, really, and negative if you're looking at the overall picture. So down by 0.3%. The CAC 40, one area of weakness that we see. The FTSE 100 and the DAX actually outperforming the rest, but the CAC 40 under a little bit of pressure. We see media stocks, consumer products and services all look a little bit weaker this morning. In fact, most sectors are in negative territory. The Asia session was a little bit sluggish. Technology delivered a lot for Europe yesterday, and so maybe pausing for breath on that particular trade. We're waiting for Kevin Warsh. That's the big set piece of the day. He and, of course, a number of other central bankers, but he's the one we haven't heard very much from in his current role, so hence the market's focus on him. But we'll also hear, Tom, from Christine Lagarde and other central bankers at Sintra. What have you got in terms of the deep dive into markets?
So those risk events seemingly keeping at least some investors on the sidelines, leading to that caution that you've outlined there for us. So you're seeing a bit of negativity, but modest given the rally that we saw yesterday and fresh record highs for European stocks on Tuesday. Today, 371 stocks in negative territory, so the majority. Losses indexes today on the upside, 214, but volumes are down about 30% right now. Let's flip the board and have a look at some of the leaders. Here's where the optimism is. Here's where the positivity is. Air Liquide and its connections to SK Hynix, with the news that it's going to be building out some facilities to provide the gases needed in terms of SK Hynix and its infrastructure and plans for build out in the US. So Air Liquide is up close to 2% on the back of that story. Just a reminder that it plays that role when it comes to AI and infrastructure, that French company. CMC Markets, results coming through positive, and look at that gain there, almost 23% for that trading company. Currently up 104 points on the back of their earnings. So very strong for that UK-listed company. Aker is currently up, look at that, almost 8%. This is an MAA deal with Schneider Electric selling off Cognite to Schneider Electric, and we'll see the other side of that story. But Aker, with the sale, getting a huge benefit on the back of that, then up 90 points. Let's flip the board and have a look at some of the laggards, and Schneider Electric is there, down 2.5%. So a little bit of negativity on the back of that acquisition as it hopes to better position itself in the AI story. Galderma, this is a story about not getting approval for a potential rival to Botox from regulators in the US. That stock taking a hit, then down 6.6% right now. JD Sports, we tie this to the Nike caution that we saw overnight with the earnings story. They're cautious in terms of the consumer in the US and China, and so JD Sports then taking a bit of a knock on the back of the Nike picture, currently down 2.6%. Anna.
Tom, let's get an update on the other stories that we're covering here this morning. It is day 2 of the ECB's Sintra conference in Portugal. Investors are awaiting comments and key speeches from a swathe of central bankers, including, of course, Fed Chair Kevin Warsh, who will be making his first public appearance outside the United States since taking office in June. FX intervention by Japan to support the yen 2 months back was successful, according to the nation's top currency official, that's Atsushi Mimura. He spoke as the yen slid against the dollar once again to a fresh 40-year low, adding that he's in touch with his US counterpart far more frequently than most people probably imagine. And Ireland takes over the presidency of the EU today. The position is key for setting the direction at leaders' summits where major decisions are made. But Dublin faces a number of challenges, from how it handles tech policy to defence. So those sectors no doubt will be a feature of our European EU government policy coverage into the second half of this year. Sticking with that EU theme, the EU says it will reserve half of its steel quotas for countries with free trade deals to protect local industry from mostly Chinese imports. The EU's preferred partners will be able to ship in 9.15 million tonnes of steel under the duty-free regime, while an additional 9.15 million tonnes will be distributed among other countries. Axel Eggert is the Director General of the European Steel Association and joins us now from Brussels. Axel, really nice to have you with us. We've seen a change in the rules then coming through from the EU. Can you summarise, from the perspective of the European Steel Association, what does this change in rules, what does it achieve for the European steel sector?
This measure is historic. It will preserve 15 million tons of steel capacity, coming back to what we lost over the last few years. It will preserve 200,000 jobs, direct and indirect jobs in the European steel industry. From this point of view, it is really shielding us from global overcapacity created by a number of trading partners, in particular by China.
Right. Does it go far enough, Axel? Are you still calling for other changes now from here to support the European steel manufacturers?
Yes, indeed. This is one pillar of the so-called Steel and Metals Action Plan. This new measure is tackling overcapacity, spillover effects on the European steel market. But we are in a transition to decarbonize our industry to carbon neutrality by 2050. And there we need also a level playing field. We need, of course, also to see energy costs decreasing, because the transition to decarbonization requires electricity and hydrogen, which comes at a much higher price than coking coal, which is used nowadays for primary steel production. And of course also we are in a steel value chain where many partners and our downstream industries also need to be part of protection that would also protect their production and jobs in Europe.
Axel, good morning. That would be part of the counter, wouldn't it? That would be part of the pushback from Europe's trading partners is look to your own house first. Make sure that you are competitive, that European steel, frankly, is not competitive. I mean, that may be part of the counter from China and others.
The European steel industry is competitive in general when it comes to the technologies we have in Europe. We have highly innovative products. However, due to subsidization and support schemes in third countries, creating excessive overcapacity, which leads to cheap exports to the EU, we are of course threatened. And secondly, we have unfortunately since COVID and the aggression of Russia in Ukraine increased energy costs in Europe, and that indeed makes us, if you want so, uncompetitive to date.
What should the priority be in Europe to address the energy cost component of this story?
Yeah, there are several ways to tackle energy costs. We have a system in Europe where the least efficient gas-fired power plants are setting the prices in the electricity market, while renewable electricity from solar and windmills is already much cheaper in its production. But the prices are the marginal prices of the least efficient plant in Europe. So we need to come much quicker to deployment of renewable electricity, and that will help us reduce energy prices, energy costs. You can also see that Europe has the highest levies and tariffs on energy globally. So there is something member states can do right now, today, to reduce energy costs for energy-intensive industries which are competing on a global level, such as the European steel industry.
Axel, and you've referenced overcapacity in some third countries, and a lot of people think about China in that context. So if the root cause of what has been difficult for Europe is too much capacity coming out of China, can anything be done on that more fundamental level, via any other means, or is this as far as Europe can go in influencing what China does?
Oh, there can be done much more. We had good discussions actually a few years ago with the United States on a global arrangement addressing global excess capacity in the steel industry. We should take up this line again with like-minded partners like Canada, UK, the US, find common ground to tackle global excess capacity jointly, so that those countries do not have any market anymore to which they could export their excess capacity at very low prices. So speaking with our trading partners is also very important. We have a staggering trade deficit with China, 2.5 times. Products in terms of value are exported from China to the EU, then vice versa. So this is a huge trade deficit. So let's speak with these partners. At the same time, let's find like-minded countries that also are suffering from global excess capacity in our sector.
What is the current, above and beyond the tariff story, the quota story, what is the current health of this sector right now, Axel? I mean, particularly thinking about the defence spending coming through from Germany, but also the challenges of the auto industry.
Yeah, we have, beyond the issue of high energy costs in Europe, we have, of course, a lack in demand. Demand decreased significantly. The European steel industry lost more than 30 million tons of steel production in the last 7 years. Last year, we produced 126 million tons, the lowest level ever, and that has, of course, as a reason low demand in Europe, but also the high import rates from those countries. We hope that the investment schemes which are currently being planned in Europe, investing in infrastructure, investing in defense, and also investing in new technologies will drive steel production in Europe again. We are decarbonizing, so this is also an opportunity for us, decarbonizing quicker than other partners in the world, by that also leading to more innovation in our sector and in the steel value chain. So I believe that we have a bright future, but of course we need to implement all the measures that are foreseen currently by the European Commission. So this will take some time. And once demand is coming back, then we can probably also see our sector making reasonable profits again.
Okay, Axel, thank you very much indeed for joining us on a significant day for your industry. Axel Eggert, Director General of the European Steel Association. Coming up, European CEOs, meanwhile, weigh the business landscape heading into the second half of the year as enterprise AI grows increasingly important. We're going to speak to McKinsey and Company's Tunde Olanrewaju next about how enterprises across Europe are adopting and adjusting to the AI story. Stay with us. This is Bloomberg.
Welcome back, everyone. This is the opening trade. Somehow we got to the 1st of July. It's now the second half of 2026, and this is the picture that greets us. Maybe we are all a little stunned by that fact. We're not going anywhere very quickly on these European equity markets. You can see overall, though, the direction of travel is a little bit weaker, but we're waiting for these risk events then, Tom. Today and tomorrow, we're waiting, of course, for the appearance of Kevin Warsh at Sintra, the ECB Central Banking Conference, and the non-farm payrolls numbers out of the States.
In the tech space, one risk event has been cleared, it seems, because the US government has removed foreign access restrictions. It's removed those restrictions on Anthropic's Fable 5 AI model, clearing it for wider distribution. The original move to block foreign access sparked a renewed focus on sovereign AI at a time when companies are wrestling with the cost of the technology. Joining us now is Tunde Olanrewaju, Managing Partner for Europe at McKinsey and Company. And Tunde, look, you travel all over Europe. You are facing, and at the coalface really, with a lot of these enterprises, European companies that are working through how to adopt and how to actually implement AI and really get the benefits from it at this time when a lot of executives are raising the question about costs. Where are we then in the adoption story? What is European enterprise doing? Are they adopting? Are they cautious? Are they holding back? What are you seeing?
Thank you, Tom. It's such a pleasure to be here. First of all, as you can expect, because the cost of cognition has just dramatically dropped, that's really what the AI promises. It's spreading. So every time a technology or capability gets cheaper, we use more of it. And so what you really have is everyone experimenting. I think our survey, our State of Global AI Adoption Survey, says 88% of organizations are experimenting with it, and about 36% actually already report some kind of benefit. A smaller proportion, 6%, actually say that there's a massive benefit. So they're really seeing big traction. So the real story is how we shift that adoption.
Is this a year or is it next year when we move from piloting this technology to actually scaling it across companies?
I think the time is now. I think what we're actually seeing is everybody moving on to a much more enterprise footing. So last year, if you will, was the year of giving everybody access to the tools. This year is a lot more around how do we pick parts of the organization and fundamentally shift how we work.
And good morning to you today. And is there something in there about buying smartly so that the costs don't rise too quickly? So when you're looking at token costs and buying the right AI tool for the job, not using the sort of super frontier stuff for things that don't need it?
It's spot on, Anna. So there are really two big things. The first one is, are you actually reimagining the work? And the other one is, are you managing the cost of AI because it's not free, right? So if you think about the reimagining the work, one mode is to give every developer Copilot or something to allow them to code faster. Another mode is to say, I now need 2 developers and 10 agents, and I fundamentally change how I create it. But to your point around the token economics, which is sort of the term that's sort of spreading around now, it's about picking the right model for the right job. Frontier models can be up to 10 or 100 times more expensive. than cheaper models. And so picking the right model has a dramatic effect on whether what you've built is actually efficient.
And I guess then also having the right organisational structure might be really important as well. So how are you seeing companies reflect on that? Because some companies, we talk to them about AI and they talk to us about, yes, what the tech team can do and what the programmers can do. Yeah. And others talk to us in a much more holistic sense about what the business is doing as a whole.
It's spot on, Anna. So most businesses are sort of designed and organized around rationing expertise, right? So this is expensive, and now the expertise is cheaper. You don't have to organize that way. So as a result, the companies that are really making the biggest shift are realizing that all of the structures around escalation, around scarce access to expertise, etc., that doesn't hold true anymore in the world of AI. So therefore, do I need a customer service department that has one manager and to 20 people, or do I need one manager to 300 agents and 2 or 3 people steering the agents? That's a fundamentally different economic structure.
You said in one of your first answers, I think 88% of companies in Europe are using this technology, experimenting. It makes me question what the other 12% are doing. 36% are seeing a return on investment. Is that right? 36%?
So 36% report P&L impact.
Okay.
Right? But 6%, which is a much smaller number, report at least 5% of their EBITDA driven by AI outcomes.
So what needs to happen to move that 6% to 20, 30, 40%, and that 36% up to 80%?
So the first thing is obviously this reimagination, picking the places to go. And what you already see is evidence of where this is going to materialize fastest. So in software development, I think that game has already happened. And you see it with native software firms already changing how they operate, but most large enterprises haven't gotten there yet. And then you look at all the stuff to do with customer contact, right? So do people really want to browse online when they can just ask a question to a chatbot? Do they even want to go to the website if they can just buy it through the LLM? So these are the sorts of things that you're going to see coming down the pipe.
And overlay this onto, I know that you at McKinsey have been doing some research on the cost base of European companies. Yeah. I mean, how does this, and we were just talking to the Steel Association about the cost of energy, for example, for European companies. But R&D and manufacturing costs, according to your research, run 50% to 300% higher than global competitors. Yeah. Is AI going to help then, or it just adds to the costs?
So AI is absolutely going to help. And it's worth just mentioning a little bit about what that research is. So it's the Catalyzing Competitiveness report from McKinsey Global Institute. And what it said is rather than look at each country and say who has higher energy costs and who's got lower labor costs, why don't we look at the end-to-end cost of actually putting something in, which starts from, is it easy to get permitting? Is there access to the grid? Are there kind of expertise clusters available? And when you look at it end-to-end, you start to see the differences. So you don't always have to have the lowest labor cost to be competitive if you're faster at permitting, because then my financing cost is lower. And so for Europe, it's saying that there's a more nuanced answer around simply just chasing the lowest cost you can find everywhere else, or trying to reduce the wage bill, or just applying AI everywhere. It really depends on which industry you're talking about.
As we think about reducing the wage bill, what are you hearing? What is the honest response when you speak to executives about job cutting as part of that efficiency gain?
Right. So first of all, the history of technology has not been more leisure, right? We all have dishwashers at home, but we don't spend less time in the kitchen. So my thesis is that there's aggregate job opportunity. Obviously, there's a transition along the way, and that's what we have to navigate. There's a really interesting report, actually, that came out from Ramp and Revello. So Ramp does enterprise payments, expenses. Revello looks at labor market data, and they actually find companies that spend more on AI are hiring more. So that the data shows about 6 to 12 month lag, but 10% more workers in the companies deploying AI more intensively. So I think there's an interesting story there.
There's a lot of churn in the labour market, but then maybe not lower employment?
Absolutely. I think there will be shifts, right? And we can't get away from that. But in aggregate, I think there's more opportunity. I think we're going to be doing more types of work, and there's a lot of latent work that's just not happening.
And you still need to hire the young people. Is that also the message Tunde?
Absolutely.
Tunde has views on this.
I mean, Revello's analysis said they were hiring more young people, so 10% overall, 12% more young people. Right. So I think it's a nuanced story. Yeah.
Tunde, really, really interesting insights. Thank you very much indeed for coming on set with us this Wednesday to walk through that AI story across European enterprise. Tunde Olanrewaju, Managing Partner for Europe at McKinsey & Company. Let's turn to the broader markets right now. Drum roll, of course, to 2 p.m. Fed Chair Kevin Warsh, alongside other central bankers, speaking, of course, at Sintra in Portugal. Skylar, is this more important, or is it the jobs data tomorrow?
I mean, 100% the jobs data tomorrow is more important. But I think
there's a lot of conviction.
I know.
There you go. That put us in our place.
Well, I mean, I think if you just think about it, right, we didn't get a lot in terms of guidance from Warsh at the last meeting. We got a clear stance on inflation fighting credibility and the fact that inflation's been too high for too long. And that tells you that the data is what matters and that we had inflation be very high. It's continuing to be high, if not rising, right? Core PC, the last print we got out of the US, was 3.4% and a rise from the previous month. So that's very concerning. And the jobs data is holding up very well. So you have more focus on that, inflation mandate with that case. And you had JOLTS yesterday that was very strong. And we didn't get a lot of guidance in terms of what that actually means for policy at the last meeting. And Sintra is a 1-hour panel that includes 3 other central bankers. I don't think it's going to be very hard for him to avoid giving guidance.
Yeah, that's interesting. And what will he talk about the task force and task forces and just sort of push forward into that conversation rather than get waylaid by or tempted to talk about the inflation outlook? I mean, I suppose that's it. But let's talk about the jobs report then, Skylar, as you've suggested that it is going to be much more interesting. These two things are kind of high risk, aren't they, I suppose, for the markets in the next couple of days?
Yeah, absolutely. And I think part of the story is that we've had a number of very strong jobs prints. So if this one comes in strongly, it'll be the 4th in a row. There is some element of that where because you have the World Cup going on, you'll have higher labor reports because of hospitality and leisure hiring. So there's certainly an upside risk to this report. But I think, the risks are very asymmetrically skewed towards higher yields, given that you've had such a strong trend of economic data, strong trend of inflation being above target. So it needs to be quite a downside surprise, I think, to deter that momentum.
Can I get your take on what's happening with the equity market? So European stocks at a record high yesterday, a little bit of caution today. A really strong quarter, essentially. Yeah. You have warned us previously that the energy story out of the Straits of Hormuz would catch up in terms of margins. I think I'm roughly paraphrasing you accurately. Does that still come to bite in the second half? Is the margin story a challenge for European stocks in the second half, or are we kind of past that?
I don't think we're entirely past that. I think you still need to consider the fact that that's in the pipeline from margins. But I think maybe more overwhelmingly is that we have strong, resilient growth generally in the globe. And I think I'm still much more optimistic on U.S. equities versus European equities. Part of that, I think, is you've had a strong retail bid. So Citadel Securities is the #1 market maker for retail, and they've shown that you've got record buying from retail in June and May, and they're very much buying the dip, and so that's likely to continue.
Skylar, thank you very much. Skylar Montgomery-Koning from the Markets Live team. She will be, of course, watching what's happening in Sintra. We will be watching what's happening in Sintra. We will be speaking and hearing from Joachim Nagel, the Bundesbank president. That conversation at 9 a.m., which is moments from now. Some slightly better data coming out of France, out of Germany, just on the manufacturing side, so we'll keep across that as well. On the Pulse, that is next. This is Bloomberg.